At Prodeus, we specialize in connecting businesses with top African tech talent. Be you a startup or a corporate company, whatever your hiring needs are, Prodeus is the place for you.
Outsourcing with Prodeus means you get access to a global pool of highly vetted tech talent. From developers to designers to product people to data analysts, we ensure that the right and the best talents are working on your team and for you.
Looking for permanent hires? Our recruitment team is designed to match you with the top talents quickly and efficiently. We take care of the heavy lifting, from vetting candidates to getting the right cultural fit, so you get the best, faster and quicker.
Outsource the right tech talents, recruit the best fits.
Find your next tech hire with Prodeus.
We make tech recruitment simple, fast and efficient.
Hello.
Hello, how are you?
I'm doing okay, and yourself?
I'm fine, thank you. I'm guessing we're live now, so yeah.
Yes, we are live. So for everyone who's already joined us, welcome to today's fireside chat between Mr. Shola Oshinoike and I. And we will be talking about what investors really look for before investing into a startup. What are the unspoken rules that you may not be aware of when they're reviewing your pitch decks before they give you that final yes or no. And Mr. Shola, this is something that many founders tend to really be very nervous about. And I'm really hoping that we can go into this today and then give them some insights into how to prepare better for their next pitching session with investors. Yeah.
Great. So how do you want to kick this off?
Well, let's do first things first, I guess, introductions. So I would love to introduce you, but maybe just snippets, because I don't think I'll do you justice. But I'm happy to have Mr. Shola on the stage with us. He's a prolific investor, but not just that, he's one of the silent corporate giants. He's worked for how many of the big fours, apart from McKinsey, but you've pretty much worked for almost everyone else.
In one way or the other, yeah. But mainly PwC and Accenture, yeah.
Yes. And of course, you've also been with Naspers. And I think there's one key event during your time at Naspers that keeps me still humbled. You could touch on that a little bit about the, what happened with eBay.
Oh yeah, the eBay, yeah. So Naspers reached out to buy eBay, which was, I think it was an 8.9 billion investment to buy. And just being part of that deal and being in the back office and doing the due diligence to ensure whether that deal can happen or not is always interesting. And in the end, I think Naspers lost out by a fraction of millions. But they stand to live again. And for those who don't know Naspers, they've just recently bought Just Eat. I can't remember the numbers now, but so it's a prolific investor. And they're known particularly for their initial investment in Tencent, which still stands out to be one of the best investments. About 20-30 million investment, now producing about 100 to 150 billion. So interesting.
Very interesting. That's quite fascinating. It just sort of shows that you've been quite hands-on across the almost entire spectrum of private equity. So you've been, and you've also been on the other side of the table, working in the startup in the UK, Deliveroo, if I'm not mistaken.
Yes,
so
correct. Yes.
You understand the investing side of things. You also understand the exit stage of things when a company is about to be bought. So it means that we can really pull out those nuggets, because obviously the goal of every investment out there, apart from doing impact, is to generate a return.
Yes. And maybe right at the top, maybe we should, do a spoiler alert, right? So, because, I love the title. The title is What Do Investors, Want? And I think at the very top of what investors want is that they want a return on investment. Like no matter what stage of investment you're at, whether you are a Naspers investing billions, SoftBank recently just invested 30 billion in OpenAI. Ultimately, they're looking for a return on investment. Or whether you're just an angel investor who's putting money into a startup that's come knocking on your door, ultimately you're looking for a return on investment. Now, you could say that investors are also looking for impact. But we'll unpack a little bit more about that. But ultimately, I think, at the highest level, it doesn't matter whether you're Series A, Series B, pre-seed, seed, whatever bridge version of that you are, ultimately an investor is looking for a return on investment.
Fantastic, fantastic. And I am David Ogundekor. I almost forgot to introduce myself. I'm the founder and CEO of Phonema. Phonema is a venture building investment firm. And what we do for founders is to help them meet those KPIs internally in terms of traction and having an investable or backable business model to ensure that when they do get to engage with investors, they can generate the returns that investors are looking for. Now, going back to what you just said, Mr. Shola, ultimately, yes, return on investment is what investors are looking for. But when you engage with founders, what are the signals, so to speak, that you would find in a founder? And I know that this is actually quite relative to the stage of the founder. If you're at a pre-seed stage with such an idea, or maybe they're in the much more mature stage, getting close to Series A, Series B, or maybe a growth stage in the business development. So obviously the signals will be quite different. But feel free to choose any one of them to focus on or to go across the entire spectrum. But what signals do you tend to look for, or do you think investors look for, that founders should be aware of, and they should focus on ensuring that they have the signals before going to engage investors?
Yeah, I think that's a really good question. And I think, it's kind of like starting at the very, very, very top of the equation. And I'll try and do it justice by going broad and then, narrowing it down. Because if you look at it from a broad point of view, and we talked about ROI, and we're probably going to talk about it a lot throughout this session. But one of the things that investors are looking for is that they want to connect with founders or do business with founders who they believe can return the money they invest in back to them in one way or the other. Now, I think investors know, and I say this to angel investors because that's primarily what I've been doing the last 2 years, is that of all the investments as a human being you can make, angel investment is probably the most riskiest one, right? So it like if you do bonds, you do stocks, you might see your money, but angel investing is one of the ones where you're almost guaranteed. Like there's two sides: either you get your money back, or you lose all your money, or like it's kind of straightforward, right? And I think that's the thing, is that ultimately what investors are looking for is, do you as a founder understand, number one, that the money you're asking for is going to have to be returned in one way or the other. The next thing founders are looking for is this, what you call a problem solution fit. Like, do you understand the problem? Do you have a personal experience around the problem? Are you doing this because you want to become the next Uber? My favorite hate line in a pitch deck. Or are you doing this because you have a personal story, like you have a personal story that is driving you, like a personal experience? Like some of the best pitches I've seen or is where the person who's pitching has a personal story. Like, I'm doing this because I've experienced this. I'm in health tech because, my mom died of cancer, or I'm doing education tech because, I know that there's not access to a lot of people to have education, or I'm doing a fintech because I know that there's people in my village that don't have a bank. And so when you have a founder who has a personal reason, a personal belief around why they're doing it, so they understand the problem, but then they've also gone beyond that to say, actually, I have an idea on how to solve this. And it's not just a copycat idea. It's more like, look, here's the problem and here's the solution. And if I do all these things in the right sequence, I will solve this problem. And in solving this problem, I will create revenue. And in creating revenue, I'll be able to return your money back to you. And it's almost like you want to be talking to founders who are almost looking at you as if they're loaning money from you to go and execute on the vision that they have. That's probably the first thing. It's like a clear problem solution fit. And then depending on where you are on that spectrum, like let's say, yes, I believe in you. I believe that you can actually pull this off. I believe that you can actually do this. But what I'm also needed to know is, do you have the right team around you to execute on this. Because you could have a great idea. You could be the person that understands the problem the best and you understand the solution the best, but you don't have the team to help you execute on this. And again, I think we'll talk about it a little bit more, depending on where you are on the spectrum. Like, are you at the very early stages? So you're looking for little money. And so you need little team, little, to prove the concept. Or are you already gone far? Now you need big team, right? So depending on where you are, ultimately, what an investor is looking at is, do you have the team to help you execute on this vision, this problem that you've discovered, and this solution you're trying to define? Next, what investors are looking for is, particularly if you've gone past the idea stage and you've gone past MVP stage, so let's think pre-seed, and you're kind of going forward, what they want to know is, do you know how to go to the market and get people to buy into this idea? Do you really understand it? Like, if we wake up in the middle of the night and say, how are you going to sell your products? And you can say, oh, actually, I understand my go-to-market. I know who my market is. And I'm not just talking about diagrams with TAM, SOM, SAM. I'm not talking about that. I'm talking about, do you in your heart of hearts really understand the market and you're energized, right? Because that's the other thing. Are you energized to go after this market, or do we have to energize you? So these are some of the things that the investors are looking for. Then the other thing is, like, okay, you've come up with a solution, great solution, but is the market ready for it, right? And I always like to use this as an example. Like, I'm a writer, I've written books, but I know I'm not going to write a bestseller. Not because I doubt myself. It's not about doubting myself. I just know that what I write about is not in the mainstream bestseller. And so therefore, I'm not taking anybody's money. I'm taking my money, bootstrapping myself, write my book. If I make 10 sales, I'm happy. But if I went out to somebody and say, hey, I believe this book is going to sell 1 million, give me 1 million to make this book happen, right? Unless I can back that up, unless I really understand the market, how will an investor handle their money? And maybe the last thing to think about, there are many things to think about, is ultimately, apart from the ROI, because yes, I can get money back from you, but where is this going? Like, have you as a founder really sat down and thought to yourself, where is this all going? Or are you just in the den to play and see where you land, right? And so I think these are some of the things that investors would like to kind of understand and get from the founders when they begin these conversations with them. Does that make sense? I've kind of taken it broad, and you can dive into whatever part of that you want to dive into.
Yeah, and you're very right about the emotional connection, because in Phonema, that is something we always look out for. And we sort of play with both founders who have an emotional connection and founders who don't have an emotional connection. And we've seen a clear difference between both. And we've sort of seen that the founders who have that passion, who understand the problem because they have an experience of the problem, have this obsession about the problem. And they're willing to be resilient to really weather the storms that come with building companies. And I guess I was going to ask a very controversial question.
Go ahead.
We'll probably step on a few toes here. But I guess, can we then safely say that not everyone should be a founder? It's actually okay to go be an employee, as opposed to starting a startup because you want to be the next Uber in healthcare or something.
Yeah, it's a good question, and you're right. It could be controversial, but let's put some safeguards up, right? So sometimes what happens is that, like, particularly on the African continent, people have tried to go out and get a job and they can't get a job, and so therefore they're pushed down this avenue of, okay, why don't you start your own company, found your own company, and create your own company. But if you're asking the question whether you're in the Latin America, Europe, America, Nigeria, Africa, it doesn't matter where you are, the question is, the truth of the matter is that not everybody will make a good founder, right? Mm-hmm. That's a fact, right? Some people are better at support people. And also, because you're a tech genius, doesn't make you a founder, right? Because you can develop a product doesn't therefore make you a founder either. I think, like you said a little bit, a founder has to be somebody who is passionate about a particular thing and is willing to be resilient, to show grit, to push through, because like no matter even if somebody gives you $1 million to start and say there's $1 million, go found a company, even with all the money in the bank, the founder's journey is still a hard journey. Like this is I don't care who the founder is, they will always tell you that it's a hard journey. And I think the problem is a lot of people go into the journey thinking that it's going to be a doddle. All I need is money. Well, actually, you can have all the money in the world and still not be a good founder, because at the end of the day, you're trying to solve a problem. And if you're trying to solve a problem, you need to convince people that you're the right person to solve the problem, and people need to buy into the solution you're providing. And so there's a lot of things that makes a good founder, right? And so investors generally are looking at good founders. Now, I think a lot of people will say post-COVID now, a lot of investors, whether they're angel investors all the way to institutional investors, seem to have an affinity stronger with second-time founders, third-time founders, because they're like, you're not just coming to this party for the first time. You've been to the party, you know the pain, right? And so therefore, maybe investors are more heightened to invest in a second-time founder. Now, I don't think it's fair, but I think you can understand why, because they're saying to themselves, look, the founder journey is a difficult journey. You know, in fact, some VCs are even more interested in founders who failed before. That's kind of like their criteria. If you failed before, they know that this is not an easy journey. And so you're starting off. So you failed before and you've come back into the fray. That means you kind of understand what it takes and you're willing to circle back. Because a lot of people fail and then they run away. So I think there is something to answer your question, which I don't think is too controversial. Does everybody have the capacity to be a founder? No. And investors know that. And so as part of the sifting process, they are trying to sift out founders who are just doing this because there's nothing else for them to do.
Fantastic. Thank you for sharing that. And in your previous answer, you also touched on something else about you being an author, and you know that you're not exactly writing mainstream books, and you're not going to make a lot of money out of it. So it makes no sense going to raise money from an investor to sponsor or to finance your book production. And I think what you were essentially touching on is capital allocation.
Yeah.
And then, so that could be a skew. Actually, that is a skew that many founders don't exactly have. Now, so if you were to advise a founder on how to show their appetite, it could be experience, or at least aptitude at the very least, on how to manage resources. What do you think a founder should have done beforehand? Before engaging an investor, to prove to them that, look, if you give me $1, for every $1 you give me, I will generate $10 to $100 in return when the time is right. And how should they be able to communicate that to the investor as well?
I mean, I think that's a really good question. And actually, the good news about the question you just asked is that it doesn't matter which investor you're talking to, whether you're talking to an angel, whether you're talking to a VC, whether you're talking to an institutional investor. Ultimately, an investor wants to know that you as a founder or somebody in your team, let me even extend it broader, somebody in your team understands how to manage capital efficiently and effectively. And not only do you understand it, but you've actually put your own skin in the game and you've already started to do it. And so when you go talk to investors, ultimately, two things will come into mind. Number one, how much runway do you have left, right? So for you to be able to answer that question, you need to be on top of your numbers like crazy. And you can talk to that yourself, David, because you help organizations with this. But understanding your runway, understanding that as I'm coming to you asking for $100,000, I'm asking because I know that if you give me $100,000, I've done the math and it tells me that $100,000 get us to MVP, get us to market testing, gets us to traction, and also pays for my team or pays for resources, and that gives me 18 months. So I probably won't be going out to ask for more money for 18 months from now. right? And investors want to understand that you really understand that, and you've just not written that down in paper. And so they would dig into that and say, what do you mean that you got 18 months? What if this happens? What if that happens? What if you understand? And I think one thing that investors are definitely looking for, and that I look for as an investor, is, do you understand the dynamics of your ecosystem? Do you understand the regulatory requirements that you're going to face? So I remember talking to a fintech once, and they were operating out of Nigeria, and like they hadn't even considered the fact that they have to go and get a license. They were like, "Oh, we'll just launch the app." I was like, "Dude, stop! You need to get, like, there are levels of licenses, but for even you to start this, to even open your bank account, you need a particular type of license. You haven't even factored that in. And so that makes you begin to feel nervous around that founder, because you're not sure they fully understood all the ramifications of what they're trying to do. And I think most investors, well, I don't say most, all investors have this concept of doing the due diligence. So as you're talking to them about what you think the market is, and as you talk to them about how much you think things are going to cost, they've already done some of that before. Generally, if you're talking to a VC, they've had analysts that have analyzed your runway way before you. And now with AI tools, they can do even deeper analysis before they even start talking to you. And what they're trying to validate from you is that, do you understand the risk of the road you're on? And what have you done to risk mitigate yourself to ensure that you can bring this product to market, you can sell the product, and then you can actually make money, and in that way pay back the investor. So I think being able to demonstrate that, which is quite a lot, like what I just said now, for some founders, that feels like a heavy load. They're like, well, I don't have a CFO and I don't understand numbers. I've just built a product. And so therefore, when they start talking to investors and they're having these conversations on ROI or what's your runway and why are you asking for 100 and not 200? And, like those questions become a little bit complicated for them to manage. And then your favorite question is, what is your valuation? Right, so you're coming to me to ask for me for 100,000. Whether you're asking for a safe or a convertible note, it's going to be based on how much are you valuing your company. And then, I've been in rooms where I've just laughed my head off, because by the time somebody values their company, I'm like, dude, you already shot yourself in the foot, because how have you valued your company to be 5 million? Like, you're not even off the ground yet. You're not even at idea stage, and now you're valuing yourself at 5 million. So I mean, I can throw that question back at you. like it would be interesting for people to learn from you also, from your experience. How do people manage that?
Yeah, so, well, I can talk about what we do for founders, because on one hand, you've got the cash they're burning on a monthly basis. And what we try to do as well is that we try to model the revenue projections at the same time. So that way, if the cash, because we've got the gross cash burn, we've got the net cash burn, which is basically the free cash flow. And if we can help them, build enough revenue traction and momentum towards the end of the runway that can buy them more months, so that once the runway is over, with the cash left in the bank, they can finance the next 6 months or the next 7 to 8 months. That would also give investors confidence. If that also would give me confidence that the founder will not be cash strapped, because once you're out of money, the company's dead, and that's the end of that investment.
Yeah.
So we help the founders in our portfolio to think through that and then to plan for that as well.
Yeah, and I just want to say, because if people are on the live and they want to throw in some questions, please do that, and so we can answer some questions too. But maybe let just give me a second. Let me be super controversial and go up and down for a second, right? And so, look, the starting point of this conversation really is what is the best money to actually take? Right? And I always like to talk about this. Like, in my humble opinion, here's my view. My view is the best money for any founder to take is customers' money, right? Because customers' money is benched on the value you're creating for them, and they're paying for that value. And so at the top of the tree, I would encourage every founder to find a way to take customers' money. That should be your primary focus. Now, don't get it twisted. I'm trying to say just bootstrap and don't take investors' money. I'm not saying that. I'm just saying that if you want a smooth, independent journey, then focus on getting customers' money. And even if you want to take investors' money, you still need to focus on taking customers' money, right? Getting customers' money. So that's probably my starting point. Then the next point is, a lot of people say to me, particularly, let me just talk to African founders for a second who are at the early stages, who are sending out those cold emails and trying to reach VCs, particularly. Most of the time they're talking to me that they're trying to reach a VC, and the VC is saying, show me your traction, show me your revenue numbers. And people are like, why? Like, look, we're just starting. Can't you just, invest in my idea? And I think COVID has woken the world up a little bit. And post-COVID, it's not as easy for you to see money being thrown around as it used to be thrown around. Now, and one thing we have to not confuse is the fact that people are not throwing money around doesn't mean there's no money. There's lots of money. I think the last review I read is that there's $2.3 trillion of dry powder. That is money available to be invested in startups at any stage, from idea all the way to Series G or F. And that's why, when OpenAI says they're raising money, somebody can write a check for 30 billion. So think about it. I mean, SoftBank is sitting on 30 billion ready to invest, and there's many other people that took part in that round. So there is money. The problem is people are more adjusted to holding on to cash than to taking a risk, because any investor, I don't care who you are and how much money you have, ultimately you're trying to manage your risk. Right? You're trying to manage the risk either for yourself as an angel investor, or you're managing the risk on behalf of your LPs, GPs, or people who've given you money. And so what's happened now is that investors are asking more of founders than, hey, I have a great idea. I remember once a founder called me up and said to me, oh, I have a great idea. I can't even tell you what the idea is, but when I tell you, you're going to realize that my idea is worth 10 million. I was like, okay, great. So it's like, I don't even know where to start with this conversation now, because you're saying your idea is worth 10 million, but you can't tell me what it is because, and 5 years later, the idea hasn't even come out of the box, right? Because people had this mindset that if I tell you I have this great idea, if I don't want to tell you about my great idea, because you might steal my great idea. And actually, ideas are to a penny. It's the execution and delivery of that idea that's key. So what I'm trying to say in summary is the bar for what startups need to present to investors to show themselves to be investor worthy has dramatically increased because of the nature of the world changing and because of the nature of so many failures that have happened, not just in Africa, all over the world, literally every day, right? And that number hasn't changed, that, 99% of startups or whatever the number is, 99, 97, choose a number, doesn't even matter, fail. It's just the truth, right? And so for you to stand out and for an investor to look at you and think, you're worth me putting my money in, requires you to come to the table with an edge. Right? An edge. I understand my market. I understand my customer. I know how to make money. I know how to build a product. I know, like you've got to come to the table with an edge, because as they're talking to you, there are probably 10 other people who are dropping in their DMs asking for money also.
Fantastic. That's yeah. And you did mention that the landscape has changed, has shifted. And I think it's only going to get worse with AI now, because with AI, the edge that some founders have, especially the engineering founders, it means that they might actually lose that competitive advantage. So how do you see this transforming the fundraising landscape in the next 1 or 2 years? And what do you think African founders should think about doing to get themselves ready?
So I think the advent of AI, and I can't, I'm gonna misquote, I'm sure, but somewhere between 40% of code that is written today has some level of AI influence, whether it's co-pilots or there's like, literally, I mean, you've seen it. I'm sure you've got it on your Instagram. It tells you can literally go to AI, rep IT, or there's so many, like there's too many to even think about, right? But you can literally say, I have an idea for a dog walking startup. Can you create a landing page? Can you create a paywall? Can you create, and literally you can just tell it everything it needs to do, and bam, you have a product. Well, thank you, Isaac. So bam, you have a product. And so therefore, this whole product and product market fit is kind of like almost a given, right? Let me switch it for a second to kind of give context. I was listening to a lady who was talking about what are we going to do in universities because AI is everywhere. And she says, well, you start with the view that make the assumption that everybody has used ChatGPT to write the essay, right? So start from that assumption. Like start from that assumption that everybody's used ChatGPT to write the essay. So you have to examine that essay in a completely different way now than just the fact that it is a good essay. Because, you can get 10 essays and there's no personal thought that goes into it. So it's like doing an open book exam, right? So I think the startup space is now in the world where you can't, I doubt, right? I doubt you can walk up to an investor, choose whatever investor it is, and tell them that I have an idea, but I don't even have a landing page yet. Right? It's almost like, dude, like, it would have taken you 10 minutes to get a landing page before you came to talk to us. Right? Do you see what I'm saying? So I think what AI has done has raised the bar of what is the starting point before you start having a conversation with an investor, because they know that to get to product, whatever that product is, at least even a sample of the product, is a lot easier than it was. You don't have to hire 10 people, 20 people. Now you can actually just do that all by yourself. So what's going to stand you out is not now just the product, even though the product is important, right? So as much as I'm saying that you can knock out a website in 5 minutes, we know that there's a difference between a website that's been knocked out in 5 minutes and a website that's taken thoughtfully thinking through and designed, and the difference between that took 5 minutes and that's taken 2 days. But what we're saying is the starting point now for founders in the event of AI is not product anymore. It's now, what story are you telling me about your product? Why are you the best person to bring this product to market? What do you understand about the market that you're about to play in that stands you out? What customers have you engaged with that proves the concept that this is viable, right? And it's all those additional elements that we tend to ignore because they're like, oh, I'm working on a product, right? Okay, dude, there's a product, there's an MVP. Like you can knock out an MVP very quickly. The question is, you as a founder, what are you bringing to this conversation? What are you bringing into this product that gives the product life? That gives the journey life.
Fantastic. And this just sort of like buttresses the point that we made earlier, which is the fact that now it's going to be less about the tech wizardry and more about the business model. And it means that founders have to go out into the market, engage the market, generate revenue, prove the assumptions on how they're seeing the market, because now raising money to build a product is no longer a barrier.
No, although you would still find lots of people that come to you and say they want money to build an MVP. Now, just because I'm sorry to interrupt you, but David, there's a last question from David in the chat where he says, what red flags should founders look out for when evaluating potential investors? Interesting question, David, and thank you for the question. And I think we'll tag team on this question, David, because I think you'll have an insight also, right? So I think from my side of the equation, what I would say is what red flags founders should be looking out for is, number one, people who are looking for a quick return on investment, right? And you know what? Actually, as I'm going to be honest, it also depends on where you're at, right? So, David, if you already built a product, you already got customers, you already got traction, and you're trying to grow. Because also, what the question also we have to ask ourselves is, why have you gone to that founder where you at the stage of your journey? So the red flags might be different if, for example, you're already proven the concept, you already got paying customers, and then a founder comes to you and says, I want 45% of your company for 20 grand, right? So that's probably a straight up red flag there. So I think the red flags I don't want to give a general answer, but I think the red flags would differ on where you are at on your journey. But I think the starting point of the red flag is an investor who doesn't see that this is a journey, right? If they just see this as a quick transaction, I give you 5 million today, and then I'm looking for the money on the other side. If you don't see someone that wants to come alongside you, that realizes that this is a journey you need to go on, that potentially is a red flag from my point of view. But David, what do you want to add to that? Because it's a broad question.
Yes.
But
it is a broad question, and even what you just said, there are two sides to it. There's a technical side to it, and then there's also the thesis side. So you've just covered the thesis side, but from a technical perspective, you also have to understand what stage of the fund life is the VC at. If they are towards the end of the fund life, then obviously, if they're investing in you today, they'll probably want to force a return in a year or two. But if they've just closed raising their fund, then it means that they've got probably 5 to 7 years or even 10 years to wait for your company to generate a return. So you have to do your research on the VC. Understand your thesis is very important, because we have two kinds of investors out there. You have the one that is driven by a very strong thesis of finding gems or diamonds in the rough. So these are the kind of investors that would take their time to build with you. But then on the other side, you've got investors who are just looking for the next trending startup, the kinds that tend to change their investment thesis maybe every 3 years to align with whatever is trending, where capital is flowing. And if you're trying to build something that is unique, then you don't need those kind of investors, because they will most likely waste your time, or they might write you a first check because they just want to see where that will lead to. But when it's time for you to double down, or when it's time for them to double down in the next round, they likely will not want to do any follow-on funding. So you can bear that in mind when you do your research on VCs. And I think David also asked the follow-on question: how can founders research on investors' portfolio and interest before pitching? You can send them a Q&A. It's a two-way street. And just as they're doing due diligence on your business, you can also send them a few questions. You can ask them, things like, what have you invested in the past? Would you be open to introducing me to a founder in one of the portfolio companies? And if they say no, then that already is a red flag, because it means that they're not exactly valuing your own due diligence, because it's kind of like a marriage. Once you get an investor in your company, you're in it for the next 10, 15 years. And you need to be sure that that is a partner that you can trust and is willing to be transparent with you. And if the investor is not transparent or willing to be transparent, then there's already power dynamics at play, and you should run away from such investors. It's more than just raising capital. It's about having a partner that believes in what you're building and can really step up every time you need them to step up.
Yeah, and maybe it's a good point also to distinguish between angel investors, VCs, and PE, for example. So an angel investor, 99.9% of the time, an angel investor is investing their money, generally, or they might be part of a syndicate. And so they're investing their money. So the questions they look at, the questions they would ask will be very different from the questions that a VC would ask. Because remember, they invest in their money, right? And David, you spoke to it just now, the fact that if you then go to a VC, it depends on where they're at, right? A lot of VCs will tell me that they know they invest in 10 things. They know that 2 or 3 of those things is what's going to really produce the return. And so I think understanding the journey that the VC is on, understanding the journey that the angel is on, is also a good way in your due diligence of whether this is the right investor for me to approach, right? And also, you have to understand that everybody has a target, right? As you as a founder have a target for your company to grow and the outputs you're looking for, VCs, angels, PE companies, they all have a target. Like nobody is in this for charity, right? If you want charity, maybe go look for a grant or go look for a benevolent person. But if you're asking for investment, right? Very, very crucial. The word there is invest. Invest expects return. And so really understanding that as a founder helps you to engage better with people who are investing in you.
Okay, and we've got one more question. We've got Confidence asking, at what point do I need to reach out to investors? I mean, if I have lots of customers and the business is doing quite well, my business might as well just fund itself, right?
Yeah, and I love this question because I'm actually dealing with a company in Ghana right now that they've got good traction, they've got good customers, they're making good money, and actually they don't really need funding, but they're at that stage where they want to scale, right? They want to scale up, they want to expand out of the local terrain that they have, and so they need money to expand. Right. So this is a completely different. Like they've got a proven, like if they don't take any money, they're probably going to be fine. But the vision of the founder is going beyond the local context now. They're like a small business that realizes that what they have as a business offering can actually go broader. They can extend into different countries. So when they're going to go out for money, they're looking for money to scale, right? And I can't remember. There's some kind of rule. I don't know the rule, but David, you can help me. Like I think it's like Series A is to expand and scale. Series Seed is to prove concepts, and I can't remember, somewhere along those lines, right? So you need money at different stages to do different things, and this is where founder intelligence has to come into play, and founder's vision and direction comes into play as to what do you as a founder actually want to get out of this engagement with an investor? What are you trying to get? And why do you need the money? And understanding those principles helps you know when and how to talk to an investor. You want to add something to that, David?
Yes, of course. And even the kind of investor is also quite important, because for that business in Ghana, we do have expansion capital. And if it's a small business and they're not exactly addressing a very large addressable market size globally, then going to a VC is not the best company to go to. They can approach a private equity firm that is looking for a proven business model, very steady revenue, steady cash flow, and then the business can expand horizontally to a new market within the West African region. Then it's just a matter of either building up the franchising model and they're using private equity to finance that, because they have a much more patient approach. A VC investment is very, very, it has to be hyper growth, hyper scale within 5 to 10 years. And if they don't have that, and the only model that can enable that kind of outcome is technology. It's just technology that can bring that kind of speed and scale. And if their model doesn't exactly have that, then it's going to be a problem. They can't exactly go to a VC. So confidence, it's not just about at what stage that you are, it's also about the kind of business that you're running, because that will determine the kind of investor you need to engage. Obviously, if you want to scale a working business model, you will need capital at the end of the day. And if you're running a small business, you can actually raise debts to finance your growth, because your revenue, once the bankers go through your revenue performance, they can see that you can actually pay back the loan, and also pay the interest if you're to amortize it over a period of time. And you can leverage that to drive expansion, or you can approach a private equity firm. But if that business has some unique proprietary technology IP that can scale across multiple markets in a very, very in terms of speed, at a high speed, then of course they can engage in venture capital. And to your point earlier, that obviously would be a seed stage funding. Why? Because if they haven't exactly used technology to drive the acquisition, to engage customers, and to get to where they are, it means that they're going to be on a new learning curve. And that means that, and as an investor, I want to see that they can prove expansion with some seed capital. We're using digital channels. They can, broaden their market reach before they take them to a growth stage. Yes, it might mean that they could raise at a much higher valuation because of the revenue performance. But I wouldn't exactly say they're ready for Series A yet. But if they're using technology and they've gotten dominance in the Ghanaian market, then it's a matter of replicating the same playbook but across multiple markets. And then using cash to finance that. And for that company, I would put them on Series A track. But obviously, the valuation will be much more higher because they've got very strong financials.
Exactly, that's very good. But I think maybe just at this point also, just to throw out some gems, like let's throw out some gems. And I don't know what's happening with my lighting, so my face has gone funny, but just manage it. You can hear my voice at least. So I think just little things there, like if you're trying to scale something and you haven't IP protected when you're trying to scale, that's a red flag to an investor that you're not really thinking about it, right? So it's just simple things like, look, you're trying to scale, but you haven't done IP registration. You can't really scale because, somebody else can come in and nab that market off you, nab that product off you. That's one. Two, what are the regulatory requirements for that scaling to take place? Like, have you done your due diligence to find out what are the regulatory requirements for? Because some people say, oh, I'm operating in Nigeria, I want to expand to Ghana, but they haven't thought about, okay, hold on a second, what are the regulatory requirements to actually do that expansion? And people think, oh, I can just go and start a business in Kenya. Actually, no, you can't, right? And you go, like, it just doesn't happen like that. So those are some of the things that when you go to an investor that they expect you to have done as your own homework to come into a conversation to say, hey, I'm thinking to scale, but I've thought about the scaling conversations. I've thought about where my legal entities are. I've thought about the business that is there. I've thought about the barriers to entry, right? And I think that the difference between an investor and a founder, and sometimes that's why they clash, is that a founder is coming with 100% optimism as to why I have to be funded. And the investor is looking at you and thinking, what are the reasons why I shouldn't invest, right? And so you're coming at this as almost like, chalk and cheese, right? Because you're coming at a different. So what a founder can do, and sometimes what investors do, is that they put themselves in the shoes of the founder. I think to themselves, okay, if I was this guy, I was a founder before, now I'm an investor, I understand where he's coming from. So there's going to be a bit of blind sighting. And then you try and guide the founder to discover their own blind side spots to help you see whether this person is teachable, right? And then on the flip side, for the founder, you need to understand that the investor, even if he has the money ready to go and he's ready to invest in it, believes in you, also knows that he's investing this money on behalf of somebody else, particularly if they're a VC. And so they know that there's a risk here, and they need to measure that risk and decide whether it's worth, let me use these terms, jumping in bed with you as a founder to see you scale and expand. And I think the other thing to say, and I'm just throwing out generalizations, is that a lot of founders believe that investors have FOMO. Right? They believe that 100% of investors have fear of missing out. While that is true, it's also not true because a lot of investors have a risk mitigation, have a risk profile that says, actually, yes, I might be missing out on the next Uber, but it doesn't meet my risk profile, and I'm not willing to take that risk right now, even though it looks good on paper, smells good, feels good. But actually, my biggest test is when I look at it on my risk profile, does it meet my risk profile? And if a founder just keeps saying, I'm the best, I'm going to lead, I'm going to beat all the competition out of the park, and they do this table that I really don't like, where they say, here's all the competition, and we are the only ones that have tick, 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 tick against it, right? I see that. And for me, as an investor, that's a red flag. Because, I don't care who you put in that box. There's no way you're building a product where you're the only person that is the best and the best of everything else. Now, you might believe that, right? This is the thing. You as a founder might truly believe that, but most investors don't. They don't believe that. They believe that, unless you have something unique that's patented, that is unique to you, that there will be someone that can copy that. That's just a fact. I think giving yourself that reality check as a founder helps you to engage investors a lot better.
Yeah, I think I like to play a bit of devil's advocate on that one in terms of
go
FOMO.
ahead.
Yeah, I think that some investors do have FOMO at the end of the day, and I think that's because that's the reason why some rounds do get oversubscribed. So maybe we can also make this as a gem for founders to be aware of, and which kind of connects to our initial point of choosing the investors wisely. And I think that something we didn't unpack early on is the fact that planning a fundraising, doing a fundraising campaign requires a lot of strategic thinking. It's almost like marketing or sales, where you're looking for your early adopters, first of all, those that can see the vision behind what you're building and ignore all of the risks because they've already built an investment strategy or model that includes a bit of de-risking in the initial stages to sort of amplify their potential ROI. So founders can create like a domino effect where if they can get the early believers in the first stages, and that can then trigger, to maybe get to half of what they're raising, that can then trigger the other investors to come in because they're seeing that there's already an investor there around.
Yeah, and there's a question in the chat by the woman. But before I take that question, I'm gonna leave this particular point with saying that even though investors could have FOMO, I think the point I'm trying to make is a founder believing, like basing their thesis on the fact that this investor is going to have FOMO, I think is where the problem comes. Like I get many people dropping into my LinkedIn and saying, oh, you don't want to miss this opportunity. I was like, yeah, I don't mind missing this opportunity. Right? Just like that's what I'm saying is that I think that when a founder believes that a VC has FOMO and you approach the VC from that point of view, you miss out on doing your due diligence and trying to win them over. You're making an assumption that because you're the best in sliced bread, they want to invest in you, but they might not. And you don't know. And I think this really speaks to Adewomi's question, which is how do you play in a space where everyone is doing the same thing, right? Let's take Nigeria, for example. And I know that people from all over the world listen to this, but if you take Nigeria, I think it's at last count over 490 fintechs in Nigeria, or is it even more than that, right? But there's new ones born every day, right? And so how you play in that space is by really, really thinking about what is your value proposition? What are you bringing to the table that would stand you out? And I think sometimes we also have to play a little bit of, hey, yes, I might come into this market and beat all my competitors. It's possible, right? It's possible for me to just start a new product today and boom, I'm the one that's leading the market space. But that comes at a price. That comes at a cost. That comes at a lot of work. That comes at potential burnout, if you like. And so I think you yourself as a founder need to think to yourself, I'm going into a crowded space, right? And what's interesting is that, and I like analogies, right? The truth of the market is that if you've been to a market before, I'm not talking about a supermarket, I'm talking about a market where everybody in that market, in that section of that market, everybody is selling the same product, right? Literally, if you look into their store shelf, they're selling the same product. But when you walk down that aisle of the market, or even if you think about your supermarket, there could be a supermarket that you go to that sells the same thing as a supermarket down the road. But you, as a buyer who owns the money to buy, choose to go to a particular supermarket. Why? Because one, there's element of choice. Two, there's element of customer service. Three, there's elements of value, perceived value, not necessarily value, but perceived value. And it's the same reason why you will walk up to a counter and somebody will ask you in Nigeria, do you want to pay with money points or do you want to pay with OPay? And you choose. Maybe because your experience with one is that it always goes through the first time, and the experience with the other one is that it doesn't go through all the same time. Do you understand? So even in a crowded space, people still make choices. And I think if you dial it back to yourself and say, why did I choose to bank with the company I banked with? Why do I choose to buy the car that I bought? Why did I because it's already a crowded space. Like when I wake up in the morning, I want to buy a brand new car. The choices I have are limitless, but I'm actually going to make a choice, a decision based on a certain number of factors. So understanding what are the factors that would make somebody come to you and use your POS terminal in a crowded market is what's going to stand you out. And that's why even when a market is crowded, people still press into it because at the back of their mind, they have a, some people call it the founder's delusion, or it could be a founder's genius, right? That what I'm about to put out to the market, nobody has it. And if you have the right courage of conviction, your customers believe you, guess what? You could all of a sudden become a category creator, right? So, I mean, I've thrown in a lot of things there, but I think it does boil down to the experience that people have with your product and whether your product brings them back in time and time again. And investors also are looking at that. When they're looking at you, they're looking at, do you have something that makes people want to just come back? And that's why they ask you for, what's your traction? Right?
what have you done? And I mean, to answer your point, and I think it was Adu who asked that question, just to give you some sort of should I say thinking guardrails, not exactly guardrails, but more like thinking guidelines. If you build a strong product and if you build a strong business model, and you've got your customer experience on lockdown and it's really great, you have a dedicated customer base and that keeps growing organically. And if you see the distraction in the market where people are leaving other competitors to come to use your product, now that's already a clear signal to do what? To actually raise capital, to start buying out your competitors. And you already see that happening. You see people striking M&A deals to buy a competitor so they can increase their own market share. So even if the market is crowded, it's not exactly a bad thing. It can actually be a challenge. But the real question is, how big enough are you thinking? And how prepared are you to really play the long game? And this also draws back to a point you made earlier, Mr. Shaw, that you have to be a founder that investors will want to back. You have to have the right stuff. You have to have the right resilience. So you have to be fully prepared for the entrepreneurial journey.
Yeah, and if we kind of just want to throw out some buzzwords just for a second, like just for a second, like some buzzwords I just wrote down, and I just thought let me just throw them out because I think you hit on one of them. Like investors are looking for resilient founders. They're looking for founders who can execute on a vision. They're looking for founders who are coachable and who have integrity. They're looking for founders who have a big enough vision that can scale, right? Because when you think about investment, the idea, and that's why we started this call by saying ROI is what every investor is looking for. But for you to get your ROI, you need to know that what this founder is doing is scalable. The scalability that produces the results that VCs, angels are looking for. And then finally, you want to work with a founder that is not guessing, right? I'm guessing that my market size is X, Y, Z. But you actually want to work with a founder that's done the data-driven exercise. Like, I mean, I always shudder when a founder tells me, "Oh, we've built the product. Okay, well, how many customers did you speak to?" Oh, no. Once we'll get the product out there, and then people will just latch onto it. And that's that whole concept of build it and then they will come, right? That concept is probably out of date now because, the people you're building for can actually build it themselves too, right? So, no, that's the world we live in, right? It's what changed medicine, right? Before, a doctor was the authority on diagnosis, and then your patient comes into the hospital and says, "Actually, I googled it before I came here, and the Google said la 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 la." And so, if you don't know what you're talking about, you're already off-stepped by somebody who's just done a little bit of research, a little bit of investigation, right? And I think just using that analogy, when you're speaking to an investor, assume the investor to be well educated, well aware of the market you're in. Probably they've already invested in a competition of yours. Probably they've already themselves started a company that looks like yours. And sometimes founders get a little bit offended when somebody asks them a direct question because they're like, how do they even know that? And then you don't know, because if you don't know my history, you don't know that actually before I became an investor, I actually tried to create a fintech and it failed. And so I know what the problems are, what the challenges are. So anyway, I don't want me to ask another question.
Well, we're already out of time, but we can just
Yeah.
quickly take this question and then we can wrap this up.
Hopefully this has been helpful for people. Like this is just a chat and just bouncing ideas around and trying to get something. And maybe before we answer Adewumi's question, let me throw out my other thing that people know me for. Like, it's revenue, baby. It's not investment. Just get revenue. Like, investment is important, but revenue eats investment for breakfast. That's the new quote.
It is. I mean, because at the end of the day, right, you're in business to provide value, and in exchange for value, you're there to make money. You have to make money. And if you're not making money, then you're not exactly a business, are you?
And maybe this is another good thing, right? And I know we're coming up to answer Adewumi's question, but another good thing is the fact that if you as a founder are scared of the word revenue when it's thrown at you, maybe you shouldn't be a founder. Maybe you should be a researcher. Maybe you should be a number two. No, seriously, because if you're founding a company and you don't like the word revenue, then maybe you're in the wrong line of business, because the line you're in, no matter how long it's going to take you to build your MVP, ultimately you have to get to revenue. So anyway, so let's try and see Adewumi's question. What would count as growth for you in a business?
That is quite relative. But
yeah, and I think that's the problem. It's like growth is relative on what you're trying to raise. If you're raising pre-seed, there's something I'll be looking for in terms of growth. If you're raising seed, there's something I'll look at the growth. And at the beginning of this call, you talked about Deliveroo. Deliveroo, when I was there, we raised Series H. There are not many companies in the world that raise Series H. And that Series H, Amazon invested 400 million, right? So growth to Amazon and to us was beyond just growing. It was more like, how do we scale this baby, right? So think about it. So I think growth can be defined on where you are on the journey, really. Yes. So understand where you are, and then that's the best thing. Then
to add to what you just said, it's also relative to the size of the market opportunity.
Yes,
as well.
It does. Yeah. And I think that maybe the last question we'll take, it says, in a market like Nigeria where uncertainty is a constant, how should startups plan for sustainability? Hey, that one. Do we even have time for that question? That's a whole podcast series. That's a whole series on its own. But let's try and at least address it a little bit, right? And again, it's always easy to look at it from the founder's point of view, but look at it from the investor's point of view. I almost want to guarantee that an investor who's investing in Nigeria already has the understanding that there is a problem, right? Mm-hmm. What the investor needs to know is that you as a founder know that the environment that you're in is unstable and requires a higher level of sustainability planning for your startup to survive. So think about it. Two people come to me, one is in Germany and one is in Lagos, Nigeria. As an investor, I know that in this German market, there's a lot of things that are stable, right? But what I don't know is whether this product can thrive in a crowded market. I don't know. Whereas in Nigeria, I know that there are a lot of things that are going to be fighting against this product, but I know that the market to grow is there because it's an underdeveloped market compared to Germany. So as an investor, I might choose to go with Nigeria because I see more upside. But for me to make that decision, I need the founder to prove to me, beyond a shadow of a doubt, that they have thought about all these things that would require them to adjust to manipulate, to forex. Like I think I did a session once. I said if you're spending forex, then you have to find a way of making forex. Right? You can't be spending forex and only having naira, right? Because if that's the case, you're gonna be unstabilized because your spending is always gonna outpace your revenue. But if you're earning revenue in dollars and you're spending dollars, then okay, there's going to be a balance somewhere along the way. So I think to answer your question, I think it is very complicated. But as an investor, I'm looking to the founder to help me understand that they understand the market they're in, the complexity of the market they're in, and how they are planning to navigate that challenge, right? That's part because that's what I'm investing in. I'm investing in your ability to understand that there is a power problem in Nigeria or there is a logistics problem in Nigeria. But part of what you're doing as you're coming to me asking me for money is you're either asking me for money to overcome some of these issues, or you're asking for money to scale these issues, or you already have a plan on how you're going to circumvent these issues, and all you want is a push forward.
Yeah.
So back to you.
You did touch on a point there, and you said that it makes no sense raising money in dollars, but you're making money in naira. I mean, how you plan to offset that arbitrage issue? And I think that we can quickly touch on. I know we've got probably already out of time by 6 minutes, but I think that founders in Nigeria and in other countries in Africa should start thinking about the global market, because we've got great companies already coming in from Asia, like Zoe, for example, and they are targeted the global market. They're doing quite well. So do you think that founders should start changing their mindset? Yes, they might be, they can find a problem, in the African countries, but how about also thinking of exporting that technology or that product to the global scene?
I'm going to say something controversial. Right.
Okay.
And it's probably the wrong way to end this conversation, but I think I feel confident to do this. I feel that if you as a founder have no global ambition, like you're not thinking, like you're a founder, Nigeria is your market, Ghana is your market, you should not be trying to raise in any other currency. Look locally for people that understand your concept. They're not trying to push you to grow and expand and kill yourself, because you yourself have no vision beyond the content, beyond your country. Like you understand your market and you want to grow your market. You want to extend to the north, to the south of Nigeria. Then I would say stop looking for investors that want you to go beyond that. Because to your point, if you go and raise money, I'm thinking that the way you're going to make my money back is by scaling and expanding. And so if you have no vision of that, then my view is you have no business talking to VCs who are looking for you to expand, because founder, know thyself, right? But now, if you're a founder that knows yourself, that, hey, I've built a product that can go global, that can scale, I just need somebody to kind of give me the push or give me the money to expand, then I would say, yeah, go raise money, right? Go raise money, convince an investor. And I think that's where the problem is. Because again, like you said earlier on, for those who listen to this on the playback, not every person is supposed to be a founder. And I would say not every Nigerian founder is called to do global, like your product, the product you've designed is not a global product, right? If your product is an inverter, there is not a global product. Nobody in Germany needs an inverter, right? But in the Nigerian market, the inverters are required. You see what I'm saying? Like, and actually, the truth of the matter that most of our inverters come from abroad anyway. But this is my point. It's like, you have to understand, what are you trying to build before you go out there and start engaging with people about, come and invest in me? Because I know that the product I built is very, very focused on Nigeria. And I don't want to say anything to get me into trouble, but because I could just start naming businesses that would never scale, because they just won't scale. But if you understand what you're trying to build, who you're building for, it informs which investor you should go and speak to. Because if you came to an investor and said, look, I have a Nigerian product, it's for Nigeria, and they're like, oh, so when are you going to expand to Ghana? it's not even on your radar. You haven't even thought about the due diligence about expanding to Ghana. And then this is where the mismatch happens, I think.
Yeah. Yeah. And, to end this on lighter notes, your number one investor is your customer. And as long as you can make your customers happy and you can generate revenue through that, you will always have a business. And that's okay. That's a great place to start. And once you're comfortable, and you can see that there's room for more expansion, there's room for a much bigger vision, then you can start thinking about raising capital together. But starting out for the first 1 to 3 years, please, I think revenue financing should be a very great model to explore.
All right. Thank you, David, thank you for the time, and thank you to ProDevs for
Yes,
hosting.
thank you to ProDevs.
Yeah,
and for everyone who has joined us.
Full disclosure, I invested in ProDevs. I believe in the product, and it's scaling. It's going global.
Yeah, full disclosure as well. ProDevs is one of our portfolio companies, and it's scaling globally. The founder, the vision of the company is just it's mind-boggling, and we're happy to be backing them.
All right. Thank you, David.
Thank you. Bye, everyone.
All right. Thank you, Confidence. Bye.